So now to the good stuff. We're going to get into our Chenoa down payment assistance and DSCR products. And just a quick overview of why it's awesome to use Orion for these products. First and foremost, like I mentioned, I have my own designated support team. You guys are going to build relationships with them. They're easy to reach. They answer emails quickly. They answer their phone, call people back. You're going to love the service you guys get. Also, Orion is fully delegated for both the DPA and DSCR. And what that means for you is we don't have to send these loans off for approval. So with our Chenoa down payment assistance, we have full underwriting authority. We don't have to package these up and send them to Chenoa prior to closing. Same thing with DSCR. So that really makes a huge difference in how quickly you can get these through. Fast turn times from submission to close. If you guys are ever wondering what our current turn times are, you can jump into our portal, click on current turn times. It'll pop it up, but spoiler alert, we're pretty much 1 day setup, 1 day underwrite on everything. And we like to keep it that way. If anything gets pushed out, we usually push out the refis to 2 days, but you guys are going to be able to move loans through the process very quickly with us. Also, if you're a technology nerd and you like good technology, you're going to love our portal. Our company spent about $6 million on our technology. You're going to see that as soon as you guys log in. Really awesome. It's easy to use even the very first time that you upload and submit a loan. We have some pretty cool features, and I won't bore you guys with all of it because you'll see it when you get in there. But you can set up an alert if you guys are floating a loan and you don't want to log in and check pricing every day. You can just set up an alert that says, hey, text me when 4% is paying back at least 2 points. Easy to do that in the system. Also, our system will pull in title fees for you guys live. So when you're getting ready to send disclosures in our portal, you can type in the name of the title company. It pulls in the title fees live. It's not inflating them. These are actual real fees being pulled in from the title company, and we guarantee that they're correct or we'll cure them on the final CD. Also, our CD conditions are always listed right at the top of every approval. It says prior to CD, so you always know what's needed prior to getting the CD out. You can attach your conditions to specific, attach your docs to specific conditions. You can add notes that the underwriters actually see into the conditions. It's really a seamless process. And then also you can set yourself up to receive text notifications for each status change, like when a loan is approved, when the CD is out. You guys will have those options online, and you can also run DU and LP simultaneously. Of course, that's not something you're going to need for DSCR, but it's cool to know that for other loan types. If you guys want to schedule a training, all you got to do is scan the QR code with your camera phone on the screen. We do trainings every Tuesday and Thursday at various times. So you guys can just jump on one of those calls. Our help desk will actually take you through a sample upload and submission and kind of show you some of the key points to our system. But like I said, if you're a person that's fairly good with technology, you're probably not even going to need that. Our system's super user friendly. Also, you can click this star support button at the bottom of your screen when you guys are logged in. We have an online chat feature as well. So you can reach our help desk by phone, by email, or if you prefer chat, you can hit that chat button. It'll start out as automated, but then it will transfer to a live agent if needed. And our help desk is actually available 10 a.m. to 9 p.m. Eastern time. So 11 hours a day. They make themselves very available. One thing that's cool about our technology that definitely you should check it out when you guys get logged in is we have a free broker marketing studio. Everything in there is fully customizable. So once you're logged in, click on this marketing studio button at the top. These are actually some real screenshots of stuff that we have in there. Everything's completely designed already, but it's fully customizable. So you can change the font, change the photos. There's over 1 million copyright-free images in there for you to choose from if you don't like one of the images that's being used. There's social media posts that are already like the little square Instagram or story post. There's full-blown, like you can make stuff for your real estate agents that already pre-designed in there, but you can swap out the photos. Everything's in English or Spanish, and you can co-brand with your real estate agents, put your information on one side, their information on another. Definitely check that out. But to jump right into the good stuff, one of the things we wanted to go over on this call was our DSCR product. What DSCR stands for is debt service coverage ratio. This is a really booming product right now. These are taking off. You're probably seeing a lot of marketing from a lot of companies on these. But really, basically, this is a loan that uses the rental cash flow opportunity on a property to qualify them. So there's no employment on the 1003. There's no income docs, no W-2s, no pay stubs, no tax returns, no DTI, no DU. We really and truly just are looking at the rental income potential on that property and comparing it to our PITI. And because that's how these loans are qualified, these are investor occupancies only. So this cannot be used for owner occupied, second home, any of that. We have seen circumstances where somebody is buying a property that has some second home appeal, but they are going to be Airbnb-ing it, VRBOing it, something like that. Is really what you have to make sure on these properties is that there is rental income being generated on the property, because that's how we're qualifying them. But this is for purchase, rate and term, cash out. Who is a good fit for this? This is great for investors who would not qualify for conventional because the way they're doing their taxes, maybe they're writing off a lot, or for investors that own a lot of properties and they don't want the hassle of providing tax returns and leases and all that stuff on all of their properties. We also have an option for first-time investors as well. So we'll take a look at the requirements on that. And also for investors who need a quick close, because like we said, there's not a whole lot of conditions on these because there's no DU, DTI, income docs, that kind of stuff. So you really can close these pretty quick. What we require in the initial submission, so when you do your 1003, you're going to leave the income blank on these and check do not apply for employment. By the way, don't feel like you have to memorize this. I'm going to send you guys this recorded call, but I'm also going to kind of highlight this and bullet point it in an email to you so that you have the highlights as well. But the main thing that you want to be careful of is that you're not putting any income on the 1003. That's very important. Our system also has a block to kind of prevent you from putting income on there. You do want to list out all of the REOs in the all of the real estate that they own in the REO section, but you don't want to list any rental income or any expenses that they have on the property, just the properties that they own. And of course, we do need a credit report on these. We need 12 months on all of their mortgages. And this is so that we can meet the requirements I'm going to show you on the pay history on mortgages, either if those are on credit, that's fine. So if they're reporting on credit, we don't need a VOM. If they're not reporting on credit, we would need a VOM. We need 2 months of bank statements covering funds to close. And if this is a refi, because we do these for rate and term and cash out, then we would need to see a lease, and I'll show you why, on just our subject property, not on the other properties. And if it's a purchase, of course, we do need a contract. Again, just a reminder, in your submission, don't include any income docs whatsoever. And then I see a question in the chat: how long does the loan need to remain an investment occupancy? Can an investor move in anytime in the future? DSCR, but lenders who are doing DSCR, that's a great question, by the way. We have to be very careful that these are not owner occupied properties and don't intend to be owner occupied properties. So that is something that you want to watch. This is for investor occupancies only. So you want to make sure that you as a loan officer are doing your own due diligence to make sure this is investment. Why that is so important is because the way that we're qualifying these borrowers is on the rental income potential, on the income that the property itself is generating. That's the reason that these are no income doc, no personal income doc. So it is very important that these are properties that are to generate income. So that's a great question. So you wouldn't want to originate a loan where you thought they were going to move in afterward. That would be a no-no. So if there's no income docs, how are we qualifying these? So what we're going to do is we're going to take the lesser of the market rent, and the market rent is going to be shown on the appraisal. So when you order the appraisal, and we'll take a look at that, you're going to order the regular appraisal plus the rent comp schedule. And that's going to show us what the property, the income potential is on the property. If it is rented out, let's say that it's a purchase, just as an example, but it's rented out, and it says on the appraisal that the lease is good for another 10 months, that the person that's living there is not moving out. In that case, we would have to take the lesser of the market rent or the current lease. Normally on a purchase, we would not look at what it's rented for. That is just in the situation that the lease is going to transfer to the new owner. That's when we would take the lesser of. So you take the lesser of that divided by our full payment. So just as an example, let's say the rent comp schedule on the appraisal comes back at $2,000 a month. Our full PITIA, the A stands for association dues, if there are any. You divide that out, and that gives you a DSCR ratio in this example of 1.25. And that's what you're looking at. We don't require the ratio be over 1, and we're going to take a look at that. And we also have a 30-year interest only option and a 40-year interest only option. We're going to have ARMs coming soon. So keep that in mind. If the ratio is over 1, and when the ratio would be over 1 means that essentially the rent potential on the property is covering at least our PITI. That means that your ratio is over 1. We go down to a 620 minimum score. We go all the way up to 85% on a purchase, which is pretty much unheard of in the industry. And the reserve requirements that you see, we only need reserves on our subject property. We're not asking you for reserves on other properties that they own. Our minimum loan amount for these is $100,000. Just keep in mind that if it's between $100,000 and $124,999, our investors have a 5% LTV reduction just for those smaller loan amounts. So I like to point that out because we do see some of those here in the area. If they're doing cash out, the max cash out, this will be on the matrix that I send you guys, but 300,000 cash out up to 75%, 500,000 cash out if it's 70% or below, and then 750 cash out if it's 65 or below. Again, you don't have to memorize that. That'll be covered in the matrix that I send you. Delayed financing, that's a question that I get a lot. We do welcome delayed financing on our DSCR product. What that is that somebody that buys a home in cash, but then they want to turn around and put financing on it to recoup the what they put into the property. We do those. There's no wait. So they can do that inside of 6 months immediately after closing. That purchase had to have been arm's length, so it couldn't have been a property that they bought from their brother or something like that. We actually treat these as a rate and term. So when you're looking for DSCR, so when you're looking at the matrix to see how high you can go, you can look under the purchase rate and term section. And then we're going to use the lower of the acquisition cost or the current appraised value to determine the LTV on those. So real quick note, so you're on a refi example, we're always going to take the lower of the rent comp schedule on the rent comp schedule that you order with the appraisal, or the current lease to determine that DSCR ratio. So quick example, let's say $2,000 is what it's showing on the rent comp schedule, but they have a lease agreement for $1,400 in place, and the monthly PITI is $1,600. In this case, you are going to take the lesser of the rent comp schedule or the lease agreement when you're dividing out for that DSCR ratio. The lesser, of course, is $1,400 in this case. So you're going to take $1,400 divided by $1,600, and that's going to give you a DSCR ratio of 0.875, which is below 1. We do these. So you would just look at that section on our matrix. That means that the rent potential on the property is not covering your not covering the full PITI. That's when you would be under 1 on these. We do them. It just lowers the LTV a little bit. We also do no ratio. So when you would want to look at no ratio is 1, if your ratio is under 0.75, that's when you would want to look at our no ratio product. Or if it's a refi that does not have, it's not currently leased, because on a refi, we are supposed to take the lower of the rent comp schedule or what it's currently leased at. That's just for a refi. If there's not a lease in place, maybe they're doing, maybe they're in the process of taking it from a long-term lease to a short-term Airbnb something, and it's not currently leased, that's when you may want to look at the no ratio. And I see a question in the chat, is the interest only or fully amortized payment used to determine the ratio? So great question. And if you guys are doing an interest only on DSCR, you actually only have to use the interest only payment when you're calculating the ratio, which is pretty cool. That was a great question. So borrower eligibility, who is eligible? US citizens, permanent resident aliens with a green card, non-permanent resident aliens with a valid visa. And by the way, if you're not sure what visa types are accepted, I'm going to shoot you guys over the matrix. It's going to cover all of that in the matrix. We actually allow your borrowers to close in an LLC. That is actually very popular with DSCR. A lot of these borrowers are self-employed. A lot of them want to close in the name of an LLC. They don't have to, but they absolutely can. It's an option. All of these requirements will again be in the matrix, but just a couple of notes here on your screen. They can do vesting in an LLC, which is really, really popular and really, really awesome. So as far as investor experience, if the 1003 does not indicate that they have a current rental property, then we would ask for the addresses where they did rent out, just to simply determine, is this person a first-time investor or not? First-time investors are eligible up to 80%. If they are a first-time investor, that DSCR ratio has to be 1 and up. So that's just a requirement for a first-time investor. That's anybody who has not owned a rental property in the last 3 years. Let me give you the distinction. First-time investor is different from first-time home buyer. First-time home buyer means that this is their first time, they're our first-time home buyer, period. Whereas a first-time investor, they may own their primary residence, for example, but this is just their first investment property. So there is a distinction there. So when you guys are looking at a matrix or sending us a scenario, make sure that you know the difference there between first-time home buyer and first-time investor. A question that we get pretty often is, how many loans will Orion do for one individual? I recently closed a 6-pack where I had one investor who wanted to take 250 cash out on all 6 of his investment properties. Orion will finance up to 10 mortgages for one single individual, but we allow that individual to have up to 15 mortgage properties total. So that is pretty cool to know. So you're going to run into that sometimes, where you have investors who want to just take cash out on a bunch of their properties. A lot of times they're using that cash out to acquire other properties. The credit requirements on these, we do need 3 scores on DSCR loans with at least a 620 mid score. At least one borrower needs 2 trade lines open or closed, and no major credit events in the last 4 years. So when you're looking at foreclosures, bankruptcies, that kind of stuff, everything needs to be 4 years out. We allow 1 mortgage late on all of their mortgage properties, and 1 30-day late in the last 12 months, but not more than that. So if they've got like 3 mortgage lates in the last 12 months on their credit report, that borrower would not be eligible. When we're checking that, we are simply just looking at their credit report to meet that qualification. If you list some mortgages on the REO that are not reporting on the credit report, we would ask you for VOMs so we can check and make sure they meet that requirement. A borrower can be living rent-free if they own other properties. So let's say that somebody has an investment property, but they're living rent-free with their parents right now, that is eligible. We just have to make, like we mentioned earlier, we have to be absolutely certain that they're acquiring this property for income purposes and not to live in it. So that's something that the underwriters are going to be careful about. Any late pays in the last 60 days any late pays over 60 days late in the last 2 years will require an LOX. So let's say that they had a 90-day auto late a year ago, then we would ask you for an LOX on that. So jumping into the funds for down payment and reserves, this is kind of shocking to people, but we allow gift funds. These are investment properties, but and normally that would not be allowed for conventional, but we do allow gift funds for both down payment and reserves. The borrower needs 5% of their own funds documented in the file. If they're using a gift fund for all of the down payment and reserves. A gift of equity is not allowed. And the reason that's not allowed is because we don't allow arm's length transactions for DSCR. Also, the funds from a non-borrowing spouse is not even considered a gift, which is pretty nice. That's just considered borrower funds. Business funds can be used for reserves and down payment. Which is pretty cool. Bitcoin can be used for down payment and closing costs. Cash out can be used as reserves. So let's say the product requires 6 months reserves and they're doing a cash out, then we would just use those cash out proceeds as the reserves in the file, which is pretty cool. They can use stock, bonds, mutual funds, retirement accounts for reserves and down payment. And that is the main stuff. And again, we only need reserves on our subject property. We're not asking you for reserves on anything else that they own. So as far as the pricing, I actually priced this one right before we jumped on the call. So this is actually today's pricing. We call our DSCR product Coin. That was actually just rebranded today. So you guys may have seen some emails, but that stands for cash out only investor. And I just priced this in the portal right before we jumped on, and par is pretty much close to 6.625. Everybody knows pricing got worse over the last month, but our DSCR pricing is really and truly we're pricing out better than anybody right now on DSCR. So very aggressive pricing. These are not subject to QM. There's no initial disclosures. We're really just, the only major disclosure is the CD that goes out at the end. These are all borrower paid comp because these are a true business purpose loan. And check with your company to make sure that they're okay with this. But Orion says that you can originate in states that you're not licensed in because this is a true business purpose loan. So for example, let's say that you have your Florida license, but you want to originate a loan in Colorado for DSCR, we would allow that. Check with your company to make sure they would, but we would allow that for DSCR because this is a true business purpose loan. And yes, I see a question in the chat. Are gift funds allowed for DSCR? Yes, they are allowed, even though this is investment occupancy, those are allowed, which is awesome. So DSCR loans come with a prepayment penalty. This is pretty standard for the industry. They choose 1, 2, 3, or 5 year when you guys are registering the loan. And really the only thing that it affects is pricing. So if they choose the long 5-year prepayment penalty, it gives you a 0.5 point in additional credit. A 3-year penalty has no pricing hit. And then the shorter terms, the 2-year and the 1-year do have a pricing hit on there. There are certain states that don't allow a prepayment penalty by law, and those are just priced the same pricing as the 1-year prepayment penalty, although there actually would not be one for those states. A prepayment penalty, if you're wondering, if you're not familiar with what that is, that means if they pay off the loan, either they sell the property and pay it off, or they refi out and pay it off, this would be a penalty that is due at the closing. And how you calculate the amount of the prepayment. And by the way, the amount of the prepayment penalty is the same no matter which term they pick. The amount due is the same. What changes with the term is the pricing. That's what changes. But the amount of the actual penalty due is the same, calculated the same way. So you would take the loan amount times 0.8 times our rate divided by 2. I know that sounds complicated. By the way, I have a spreadsheet that calculates this for you. So if this is too much for you, shoot me an email. I'll send you the Excel spreadsheet that calculates it for you. But in this example, we'd take the loan amount times 0.8. You always do it by 0.8. times the rate, which this is a 4.5% rate, divided by 2, and that would be 5,400. So if they're in a 1-year prepayment penalty and they pay off the loan after 6 months, $5,400 would be due. If they're in a 5-year prepayment penalty loan and they pay it off after 4 years, $5,400 would be due. If you guys have any questions about that, or if that was too confusing, call me after and I'll be happy to explain. So you do need an appraisal on DSCR loans. These are for single family PUD, townhome, up to 85%, 2 to 4 unit to 75%, warrantable condos to 80%. We do non-warrantable condos for 75%. The requirements on those are in the matrix that I'm going to send you. There's a 5-acre max. And then seller seasoning less than 6 months, AKA flip, is considered case by case. So if you get any of those, let me know. We can take a look at it. DSCR, we're not doing this for manufactured, for condotels, boarding houses, commercial zoning, co-ops, farms, blah, blah, blah. Those are not eligible. So short-term rentals, this is something that's super popular right now. We absolutely allow this. This would be like Airbnb, VRBO. So if, by the way, the reason this says refi only, you can absolutely do this on a purchase too, but we don't care if it's on a purchase, because we're not looking at if it's currently rented as a long-term or short-term lease when you're doing a purchase. So really the only time you're even gonna say, hey, do you allow this is on a refi. So if you're doing a refi and it's currently rented out as a Airbnb, we need 12 months evidence of receipt. And how that we would calculate that, well, we would average that calculation over the past 12 months, or we would just take the 1007, that's the rent comp schedule, and take 150% of that. The reason we could go up to 150% of what's shown as the rent comp schedule is because you do get, generally speaking, more money, more rental income when you're renting these out as a VRBO than you would as a long-term lease. And by the way, if that was confusing, call me after. We can go through a couple of examples. What kind of appraisal do you need? So we just need one appraisal. A lot of lenders require 2. We just need one. You're going to order the standard 1004 for single family. That's your normal appraisal, plus the rent comp schedule, which is called a 1007. If it's a 2 to 4 unit, you're ordering a 1025 with the rent comp schedule. And you can place these orders in our portal. I highly recommend it, because when you order in our portal, you don't have to sign up. You can use any of the AMCs that are listed. That's because this is wholesale. The appraisal is done in our name. We're the ones that have to be signed up with them. So you can use any of the AMCs you see listed. You can set up appraisal panels with a lot of our AMCs. I really love Arrives. That's one of the ones that you're going to see in our drop down. They've never bought me a Starbucks. They've never sent me a gift card. There's absolutely nothing in it to me. The reason I refer people to them is because they're super responsive. They have no issues speaking with brokers directly. They reply to emails and phone calls very quickly. Great customer service with them. But there's also 14 other AMCs in our drop down. A lot of them have great service as well. If you're wondering what we're seeing on service before you select one, shoot me an email or a text, give me a call. I'll let you know what we're seeing back on that. But one of the reasons I say order these in our portal is because it automatically pulls in and tasks back to the underwriter, and you'll have your appraisal reviewed, even if that's the only thing in. We will order all the revisions and corrections for you. By the way, I skipped this part. We do allow transferred appraisals on DSCR. So if you do have a transferred appraisal, it is allowed. It has to be air compliant, meaning that if you're doing a transferred appraisal, it couldn't have been ordered by the borrower or the real estate agent, anything like that. It has to be like through a lender. Also, if you have a borrower who doesn't want to give you their payment information, you can actually defer payment when you order in our portal and then send them a link and to place the payment on their side. You do want to make sure they place that payment quickly so that the appraisal is not on hold. And I just saw the question, can a borrower live in one of the duplex units? No, because that is owner occupied. So if you have a 2-unit and the borrower lives in one side, that is considered an owner occupied property, even though they're renting out the other side. Okay, so I think we went through that. Are there any other questions on DSCR? I'm going to briefly jump into our down payment assistance because we've been getting a lot of interest on that. I just wanted to pause and see if you guys had any questions on the debt service coverage ratio loans. You are going to see this branded in our portal as coin. That's what we're calling it. And by the way, if you don't want to ask the question on the call in the chat or anything, then just call me after. My phone number is on the screen, or shoot me an email and we can chat about your scenario or your question after as well. So Chenoa, a lot of you guys has probably heard of Chenoa. As I mentioned earlier, we underwrite all of these in-house, meaning we don't have to send these off to Chenoa for review like a lot of other lenders do. If you guys have heard nightmare stories about down payment assistance, that is probably because a lender had to send it off for approval to Chenoa and was probably going back and forth for a while. We don't have to do that. So we close these just as quickly as any other FHA loan. But this is assistance in the form of a second mortgage. These are done through CBC Mortgage Agency. They're available nationwide. Why mess with DPA? Why do that? Well, obviously you're helping borrowers who need it. You can very quickly build new real estate agent relationships. Definitely realtors are looking for this product. And you are going to be, Chenoa caps these at 1.5% borrower paid comp. That's a Chenoa rule. But I like to remind people, yes, you're going to make 1.5 borrower paid comp now, but these rates are high. So the rates on these are like 5.25 right now. So you're pretty much setting yourself up for a slam dunk refi opportunity down the road. If you guys are going to refi them, always wait 6 months, because if you don't wait 6 months, you're going to be in that early payoff realm there. But after 6 months, you can refi them into a conventional loan. After 12 months, you could refi them into FHA. The reason I say 12 months is because HUD actually has a rule that says if there's a junior lien on a mortgage, which DPA is a junior lien, FHA requires that you have 12 months seasoning after that initial purchase. But with these rates being higher, it is a slam dunk refi opportunity for you guys. So you're making 1.5 now, you can make your full comp later if you choose to pay to refi them out. Who is a good fit? The Chenoa is fine with first-time home buyers. So that's awesome. They don't have to be a first-time home buyer. This does not have, I like to say this is non-first-time home buyers and first-time home buyers. I know different DPA programs have different rules on that. This is open to both. This is for credit-worthy borrowers that are just lacking down payment funds, but make sure they do have funds for closing costs. That was not necessarily the case a couple of months ago, but when pricing tanked over the last couple of months, it really ate up the lender credit that was associated with these. We are going to look at some pricing examples, but generally speaking, right now with pricing the way it is, this is for borrowers who have money for closing costs and prepaids, but not for down payment and closing costs and prepaids. So please keep that in mind when you're qualifying these borrowers. This is not going to be best for somebody who has like a 55% DTI right now with that would have a 55% DTI with traditional FHA financing. Why? Because you've got to account for the higher rate. So these rates right now are 5.25. And there's some of these, we'll look at pricing examples, but some of these are soft seconds with no payment on the second, but some of these have a repayable second that you would have to calculate into the DTI as well. So this is not going to be best for your borrowers who are like at a 55, 60% DTI as is. That this down payment assistance is going to throw them out of whack on those. There's options for low income and high income borrowers, and we'll look at those examples. So we're going to go over the two most popular. We're going to go over the Chenoa soft second, which is really only working with seller contributions right now because of discount points. After we run through this, we're going to look at the Chenoa rate advantage that works great without seller contributions. So this one, as we're going over this one, keep in the back of your head, soft second is the one that needs seller contributions because these are at over a 1 point discount and they're going to have borrower paid comp on that. So really, this particular one is you're gonna want to use with seller contributions, and we'll go over the other option that doesn't need seller contributions after this. So the soft second, this is for 600 scores and up. They need at least one score. How this works is it's held as a soft second mortgage. So they are going to have that 96.5% regular FHA plus the 3.5% soft second. That's going to put them at 100% CLTV. Do not worry about how you have this structured in your LOS system. Doesn't matter, because when you pull in your 3.4 into our system and select Chenoa as the loan purpose, it's going to override what you've done, how you've set it up. It's going to throw in that second mortgage for you and set it up correctly. You're only going to have one loan number in our portal, so don't be scared of these. We handle everything on that second mortgage for you. You are pretty much just working through the conditions on that first mortgage. We're getting this funds on the second handled for you. But this one has no monthly payments on the second mortgage, 0% interest on the second mortgage. This is a really popular option. It's even forgivable after 36 months of on-time payment on that 96.5% first mortgage. Chenoa will forgive the second mortgage. This one allows manual underwriting unless it's a manufactured home. Manufactured homes are allowed on this program. It just cannot be a manual. So 600 to 619 scores can go up to 45% DTI. 620 to 639 can go up as high as 50 with certain comp factors. I'm going to email you guys what those are. And then 640 to 659 can go up as high as 55, unless it's a manual. The reason I say unless it's a manual is because if it's a manual, HUD caps you at 50% on a manual. So if it's approve eligible, you could go up as high as 55 with that. And then 660 and up is just whatever DU will approve. This is for single family condos, 2-unit or manufactured homes. I like to really make sure you guys hear that this is available for 2-unit, because that's pretty cool. They can buy a property, owner occupied, live in one side and rent out the other side for some rental income. So it's pretty cool that this soft second allows a duplex or a 2-unit. This program allows non-occupying co-borrowers. They can be a first-time home buyer. It's not required. And they can own other properties with an acceptable letter of explanation. If they're under a 640 score, they will need a home buyer course that's completed just right over the phone, and it's free. I'll send you guys the link if you need it. That's only for scores under 640. This particular product does not allow high balance, but the other one that we look at will. So this one, the soft second, you want to keep in mind that this soft second is forgivable, is capped at 115% of the area median income. And this is very easy to look up online. I'm going to send you guys the link, but you'll just go to this site that I'll send you. You select the state and the county. It will ignore everything on the right side of the screen that it spits out. Doesn't matter how many people are in the house. You're just going to look at this one number, and you can go up to 115% of that. So in this example, this is different for every county. But in this example, you would take that 86,200 times 115%, which is 99,000. And the soft second, the one with 0% interest, no payments due, that's forgivable, allows up to 115%. If they are over that, let's say they make $500,000 a year and they need down payment assistance, totally fine. It just will not be a soft second. It will instead be a repayable second. The repayable second options, if they are over that income cap, would be, and this will be in the matrix, a 30-year term on the second with a 5% rate, or a 10-year term on the second with a 0% rate. That's only if they're over those income caps. But keep in mind, these are pretty high because it's the qualifying income for the borrowers on our loan only. So we're not looking at other people in the household, and we're only looking at qualifying income. So if they have like, alimony or bonus or whatever, you're not using it to qualify, we don't have to count it in these caps. And this is a pricing example that I just ran before we jumped on our call. I priced the 600 score, which is the lowest that Chenoa goes to. This is for the Chenoa soft second that we're looking at. Like I said, the rates are 5.25. That is at a discount. So this is why I'm saying you want seller contributions on this particular one. This product was not at a discount a couple of months ago. It is now because of the pricing environment. So this is the one that I'm telling you, you want seller contributions on unless something major changes, because this is 1.5% borrower paid comp. It's got a discount on it. So in this example, this is live pricing from today. If you had 3% in seller contributions, that 3% would pay your 1.5 borrower pay comp and cover all of the discount. So the seller would be paying the discount plus the borrower paid comp, and all the borrower would need to cover is their closing costs and prepaids. So this one, because of the discount, is why I'm telling you, you want to only look at this one with seller contributions. I know a lot of people are like, oh, we're not getting contracts in with seller contributions. So if that's the case, this one, the rate advantage is the one that I want you guys to price. The 5% rate advantage for FHA is the one that you will want to look at if you do not have seller contributions. And that's because Chenoa would pay that 5% assistance for the rate advantage, would pay their 3.5% down payment plus 1.5 towards closing costs. So this one is still working pretty well without seller contributions. So let me show you guys a couple of highlights of this one. This one requires a 640 score, and it's going to be 101.5 CLTV. Don't worry about structuring it again in your LOS. Our system's going to structure it for you. We're doing all of the disclosures for you on the first and second, and you just have one loan number in our portal. So we're going to make it really easy for you. Don't feel overwhelmed. But the major difference in this one is it is a repayable second. So this is pretty much like getting 100% financing, because they are going to be making a payment on that second mortgage. So you got to make sure that fits into your DTI. It's a 10-year term with a 6% rate on that 5% second mortgage. So you got to make sure that when you're qualifying them, that you're putting that into the DTI. A manual underwrite is not allowed on the rate advantage. And they can go up to 50% DTI just across the board. DTIs are fine up to 50%. This one will not allow a 2-unit like the other one will, and it will not allow a non-occupying co-borrower. Totally fine if they're a first-time home buyer, it's not required, but if it's okay if they are. And this one does not require a home buyer education course. It does allow high balance, which is pretty cool. The income caps are higher. It goes up to 135% of the area median income. So taking that same example that we looked at before, you would take the 86 200, multiply it by 135%. This one would go up to 116,000. This one, if they're over that cap, they're just not eligible for the rate and term. So if they're over that cap, you really would have to go back and look at the other option that we looked at, which has a repayable option with no income caps. I priced this out right before we jumped on the call. You're still looking at a 5.25% rate on this one, but keep in mind that this is 5% assistance. So the 3.5% is going to pay the down payment. And then that additional 1.5 coming from Chenoa will cover the discount points. The borrower is still going to need closing costs and prepaids. It's totally fine if you do have seller contributions. So I always tell people, if you don't have seller contributions, this is the one that you need to look at. That does not mean you can't have them. If they do have seller contributions in conjunction with this, it's just really going to lower the funds needed to close. FHA allows up to 6%. So totally can have seller contributions on this one as well. I always get asked, what about conventional? We do have conventional DPA through Chenoa. The guidelines are very clean. There's really no overlays. It's just basic conventional guidelines on these. It's a repayable second. It's a 10-year term with a rate that's just too higher than the first. So whatever the rate is on the first mortgage, the second mortgage is going to be a 10-year term with a rate too higher than the first. So the pricing just is not beautiful right now with conventional, with the current market conditions. So I'm not seeing a lot of conventional DPA come in, but it definitely is an option. You can go regular, conventional, or home ready. If you do this 5% home ready and you structure it as a 97% first, then you can use this 5% home ready to pay the 3% down payment plus 2 points towards closing costs. So it can cover, 2 points of this discount. So all that would be left for the borrower is another 0.5 point in discount, the 1.5 borrower paid comp, and the closing costs and prepaids. But because all of that adds up, I would say you probably don't want to look at conventional DPA right now without seller contributions, not unless something drastic changes in the pricing. There's always been, it's kind of frustrating because there's always been a lender credit on this. I've been with the company 2 years. There's always been a lender credit. With the pricing changing recently, it's at a discount. So I would probably only look at conventional right now if there are seller contributions. We do full underwrites prior to contract on all of our standard products, not on DSCR, but we do them on Chenoa down payment assistance. You'll keep the same loan number all the way through closing. No disclosures are required because you don't have a property address. We'll send disclosures after you go under contract. And we'll even do an additional $500 lender credit at closing if you converted your TBD full underwrite to a contract within 30 days of that initial approval, which is pretty cool. That pretty much reimburses them. Now, please do not just package up a loan and submit it if you have a major concern about the income or the credit. Use our scenarios desk for that. So if you're like, they have a late after a bankruptcy, is this going to be acceptable? Send that to scenarios@orionlending.com and CC me. They will look at documents and they will give you feedback without you packaging up a full file. If you don't know if you're calculating income correctly, send that to the scenarios desk. They reply within about 2 business hours. Really, we don't want you using the TBDs as like a throw it against the wall and see if it'll stick type thing, because we do monitor pull-through ratio for your company. And we want it to be, I would say, around 40%-ish with TBD approvals, where you're closing about 40%. The reason I'm saying such a low number is because we understand that not everybody's going to go under contract. We understand the market, and it's definitely a seller's market right now. We get that, but we do want to see a lot of these being closed. But if you have like a major concern on a credit report, income, something like that, shoot it over to the scenarios desk before you submit it as a full TBD underwrite. But this is an awesome benefit. I wanted to pause and see if you guys had any questions on DPA. And if you don't feel comfortable putting it in the chat, let me know, and you can just call me after, email me after, or email the scenarios desk. But feel free to type it in the chat if you guys can think of any questions. While you guys are thinking, this pretty much concludes our call, but I just want to make sure you guys know we have amazing pricing on our standard government stuff. We go down to a 580 with not one single overlay on our standard FHA and VA, not one overlay other than that 580. We have just a fantastic government platform with really, really good rates. So no overlays on manuals. We do condo spot approvals. So I priced out this scenario right before we jumped on a call. I did a 680 FHA purchase, and you can see that this is borrower paid comp, but we pretty much have 3.625 at par with our regular FHA. Same thing for VA, no overlays all the way down to a 580. Very clean guidelines on manual underwrites. We don't even have a DTI max on VA manual underwrites. This was a pricing example I priced out before the call, 100% purchase. We have 3.625, again, pretty close to par. And let me see what we got in the DPA. We don't have any, I'm sorry, in the chat. So does Orion have any specific doctor focused loans? We don't, but they can absolutely utilize the Chenoa. So the Chenoa is open to any occupations. So that would be great for them to jump into that one. And I want to stay on the line just for a second to see if you guys have any other questions. If you don't, feel free to drop off. I'm going to send you guys this recording, but 1-day turn times. I'm super excited to work with you guys. So